Butowsky now. I've known Ed for, Ed, how long is it? Like 10, 12 years since we did an event in Dallas. I think it was like in 2010, right? And we've known you for a long time. You've looked at the market. You've been in this RIA space for a while, and you're a pretty well-known speaker. So can you give us, your perspective on the marketplace, on valuations, global trade? I mean, I'm pretty sure that trade grounded to a halt last year globally, but it seems like valuations are still pretty far up there, regardless of where trade is. So can you take it away? Introduce yourself.
Absolutely. I'm Ed Butowsky, and I want to share my screen. So
should be able to do that.
There we go. So first of all, my goal today is to give a quick update on where I see the market being incredibly overvalued, which is not surprising to most of you who are watching. And to put things in perspective, let's start off with, I'm a traditional RIA, and I manage money for high net worth individuals.
Hey Ed, can you speak up a little bit? Thanks.
Sure. I manage money for high net worth individuals, and the challenge we have right now is trying our hardest to explain to people how overvalued the market is, but then also keeping people in the market while they can participate with the move up. But I also remember 1999, where I was working at Morgan Stanley, and I knew the market was overvalued. And I eventually just said, oh, the hell with it. I'm just going to go in with all the other managers and just go long the market and forget about balancing things out, and forget about owning bonds, and forget about owning alternative investments. And then I got my butt kicked. So I made a promise that I would never come to that again. I would always stick to what I know. And that brings me to understanding what's happening right now. So if you look at the fourth quarter, this most recently, we've had the reporting, 479 issues have been reported. 371 of the 479 beat their earnings estimate, and a 77.5% beat rate, as 357 of the 477 beat on sales. Now, remember that as the year goes on, earnings estimates come down. So these are beats of lower numbers, which I'll get to in a moment. And as you can see here, estimates for the fourth quarter were down 4.7% since December, and down 25.5% for the year 2019. So remember that earnings estimates had come down, and we have to keep that in mind as we look at 2021 as to what earnings estimates are right now. So the bottom line is that earnings per share were down 24.6%, and that gave a PE ratio of 32.2% for 2020 for the stock market, which is extraordinary. Now, if you look at 2021, you're looking at earnings estimates 44.4% gain over 2020, which would make the PE 22.3. The chances of us seeing a 44% gain is almost non-existent. It's just not going to happen, because we'll get to the growth of the world markets in a second, but it's just not going to occur. And you have to kind of put aside reality to believe that this is going to occur. So no matter what you look at, the stock market is extremely overvalued. And if you look at 2022 earnings expectations, you're looking at a 19.2% price earnings multiple. To put that in perspective, you have to grow earnings at 19% to justify what they're expecting for 2022. So again, the historical number is 15.7% is a price earnings multiple. Now, some of you will argue that because the 10-year treasury is so low, this justifies why you can have an acceptable higher PE, but you cannot accept a PE of 23 based on what we're going to see with earnings. And you're looking at a 44% earnings growth, and that's not going to occur. So that PE is going to be substantially higher for 2021. We're probably looking at a PE of about 35. Now, Warren Buffett has his own gauge, And he looks at that we're at 195% record high in terms of the Buffett indicator. And what he does is he takes the market capitalization of the stock market, in this case it's the Wilshire 5000, and divides it by a quarter of the GDP that's expected, and it's at 195% right now, which according to Warren Buffett, which everyone can have their different feelings about Warren Buffett, but he's a lot richer than all of us, he says that this is a major indicator for a negative market. Now, if you look here, you're looking on the left-hand side, you see the PE and then the cap and the cap total return, dividend yield, price to sales, price to book, Q ratio, and market cap, which I spoke about a second ago. And then you can look at the latest month ago and end of 2019. And no matter what you look at here, you're going to see that the market is incredibly overvalued. When you look at 100% means the most bearish. And since 1950, we're at a 98% rating according to the PE in the trailing 12 months. The cap, you're looking at 96%. Cap total return, 95%. Dividend yield, 94%. Then price to sales, 100%, meaning that the price to what we're seeing sales-wise is very, very bearish. And price to book is 96, and the Q ratio is 100%. This is taking the amount of money that if you were to replace everything in the market, the replacement value, it would be 100% above what it's selling for right now. And then what I just showed you a second ago was Warren Buffett's indicators. So again, incredibly overvalued. Now, this is something that I stole off of a really wonderful advisor named Jill Walensky. And I took from her recently this, showing that where we're at on the PE ratio, and let me move this around here. So we're over 35% on 2020, and we're way above the regression line. And if you look going back to 1870, you can see that we are way above any normal breakdown that you can reasonably expect from an earnings standpoint. And on a geometric basis, when you look at the Crestmont PE, we're at 187%. We're way above 3 standard deviations. Then some people will argue because the 10-year treasury is so low that this justifies where we're at. And you can see that we're looking at 137%, excuse me, 1.37% on the 10-year, which is up from the time I put this chart together. And you can see on a 1-year basis, it's starting to come back. And on a 3-month basis, it's starting to come back. Now, in order to justify and support these lofty valuations, you have to imagine that the United States is going to grow at 7, 8, 9%. And also remember that 44% of the earnings growth from the S&P 500 comes from outside the United States. So the majority of the growth that we're going to see it has to come from outside the US. And these are from the World Bank numbers. And these are estimates that we're looking at a 3.3% GDP growth for 2021 and a 3.5% growth for the United States for 2022. And the actual, or the estimate, I should say, for 2020 was 1.6. And if you look down here, you'll see a couple of economies that are expected to grow fairly well, but they don't represent enough of the world. Now, China is expected to grow at 7.9%, which is healthy, but it's expected to drop to 5.2% in 2022. But the reason I brought this chart up is that you have to have a tremendous amount of belief that the world is going to grow, and that's going to help the S&P 500 companies. And 44% of our earnings growth comes from outside the United States, and I just don't see that kind of earnings growth to support the lofty valuations.
Hey, Ed, there was a question from the audience. I'm not sure. Ken, are you there? Do you want to answer? Do you want to ask the question?
Yeah, a couple of questions. But I mean, you could talk about this for 1,000 years. Great presentation. But let's just start with where you just finished up with this emerging market stuff. Isn't what you're saying a bit anecdotal, because the New York Stock Exchange by far is the most capitalized exchange on the planet Earth, which means that it benefits regardless whether markets go up or down. These countries are pouring their money into the New York Stock Exchange. So, how can you dismiss the fact that the liquidity of the New York Stock Exchange and obviously other U.S. exchanges is really just driving this unparalleled just increase in capital? I mean, I don't see how you can dismiss that.
I'm not sure if I actually understand what your question is.
Well, my question is really simply, why do all these other countries matter when you're talking about a liquid market, when the New York Stock Exchange, its size and capitalization literally dwarfs anything and everything around the world? I mean,
yeah, I mean, I understand that. I'm just going to, Ed, I'm going to jump in here, but there's a difference between capitalization and whether or not you have an overvalued market, right? And it's not just a matter of fundamentals. It's just a matter that the S&P 500 has many global firms, and they have investment abroad, and that's expected to return on investment. And there's no global exchange right now.
And Kenneth,
and there's a huge trade finance gap that's emerged as a result of what happened last year. I mean, it was large already because China had stepped back. Now it's larger.
And also the point of that conversation, a part of my presentation, was to support the idea that a lot of our growth comes from outside the United States. And if you don't see the rest of the world growing to support sales, we're going to not see the sales match what is expected.
Yeah, I mean, I'm fine with it. I mean, I just find it to be just so unparalleled. I don't see how you can I don't even see how you can even introduce growth, market capitalization or anything else when you're looking at, I mean, who's even closest to the United States? I mean, United States Stock Exchange market. I don't see anybody even close. Right.
Great, Ken. So why don't we move on next? What was your next question?
And then the other question is, when you're talking about growth and price to value, I think that's an interesting question too. And what's throwing out all the models regarding price to value is the fact that, I mean, the size of the companies is unparalleled. I mean, you've got, I don't even know how many companies now that have market capitalizations of over $1 trillion, which has just never happened before. I mean, you've got 4 or 5 companies that represent 27% of the S&P.
Right.
So how can you dismiss the fact that the values, I guess just because it's creating so much new commerce by disintermediation or whatever, but how can you dismiss the fact that the valuations of these companies is ballooning so fast or so much faster than the price can keep up with it? I mean, how can you say that doesn't matter, that these valuations are largely because of the fact that these companies are literally crushing so many values or valuations, relatively speaking to other companies? I mean,
yeah, and Alan Schneider brought up a good point about Tesla. I mean, Tesla has a PE multiple of 1,000%. So we're talking about the value of the stock versus the value of the company. And the value of the company, to replace that, we're talking about 100% you would have to come up with to replace the valuation of what is inside that company, not the valuation on the stock market.
I'm sorry, Kevin Colas, did you have a question you wanted to ask? Kevin?
No, it's not really a question. It's that when we're saying that like the US is dwarfing everyone, that's not true, because China is as big as the NASDAQ already. There's a combined exchange, and that's just stock.
Yes.
So you're saying that Shanghai plus Shenzhen plus Hong Kong are as big as NASDAQ?
Yes. In market cap, yeah.
And are they as overvalued?
I think everywhere, like a lot of markets are overvalued, but it depends on which segment. It depends on which industry and sector. Tech
And
is
is there any risk in the market being overweight, like these 5 companies that represent 27% of the balance?
Yeah, well, it's
it's
tremendous.
always dangerous.
Yeah, the concentration, if you were to take out the top 10, the S&P returns last year dropped to 7%.
Yeah.
And if you were to take out the top 30, I think it dropped down into the negative territory, or it had no return. So the concentration has been historic in terms of the top 5 to 10 companies. And now,
And
You know,
which is strange is that it's holding. Which is strange is that it keeps on holding.
yeah, I guess that one of my questions is that we're seeing a big crypto move, like a massive crypto move, and I think some government is negative on that. Lagarde was very negative about it in Europe recently, and then you had Bill Gates' statement about energy consumption for creating Bitcoin. Yet we have this advertising cartel between Google, Facebook, and let's say Craigslist and 10 other companies.
right.
And but nobody says anything about it. They don't say boo about it, right? But that leads to they have high valuations, but I think only as long as they can sustain the cartel. So anyway.
Yeah, but I mean, like it's also a cartel that is superior to anyone else. Like Facebook is reproducing any new ID that competitors are coming with, and dwarfing them. It's like a Picasso of tech, if you want. And then Google has the best engine and the best NLP, the more precise search engine, and they're still ahead of anyone in the world. So they will keep their lead.
You said that, yeah, that's not talking about political, right?
But
So,
yeah,
I mean,
but
there's
I mean,
really
like,
there's a lot of repercussions of having these highly centralized companies, right?
yeah.
Google,
So at one
Facebook,
point,
and Amazon.
yeah, at one point we'll arrive maybe at a reset and a complete decentralization of the node of internet per se. It's basically a committee that will decide on that.
Yep. And by the way, when they split up Microsoft, I mean, look, Microsoft came back, right? When
Yeah,
they
I mean,
put all these regulations on top of Microsoft.
any of those
So it
companies
isn't necessarily negative.
any of those companies split will do well also. Whatever, it doesn't matter.
Yep. Anyway, Ed, keep on going. Sorry.
Oh no, that was it. So if there's any additional questions, I'll take them. Otherwise,
Yeah, I mean, so with all this going on, okay, so pension funds, endowments, et cetera, institutions are still holding up companies like General Motors, for example, right?
right.
Right. I mean, what if you start seeing more and more of that capital moving away to EV in the EV sector? I mean, arguably General Motors could just fold up and disappear. I mean, like we're watching Zoom right now, okay? And I believe its market capitalization right now exceeds IBM. IBM's been around for I don't even know how long, right? So I mean, I guess my question is, I'm not a critic, okay? I like what you're doing, but I think the question is, are we really looking at or are we looking at overvaluation, or are we looking at over destruction or hyper destruction? I mean, I think isn't it safer to say that there's an exceptional amount of destruction of value out there, which the Facebooks and all these other guys are benefiting from. I mean, certainly IBM had the technology to build Zoom, and they sat around and did nothing with it. So, I mean, couldn't you describe it that way and say, hey, maybe that could explain these numbers?
Well, I'll tell you, Ken, you're bringing up some great points, and I respect your point of view. I just can't help but think that everything reverts back to the mean and in the averages, and that at some point we're going to see everything go back to the way it was. I mean, I remember Mary Meeker talking about the new paradigm shift, and that everything was going to be different. and that it didn't turn out that way. There's going to be some companies like Amazon, they're going to make their way through, you know, where they had incredibly high PEs and they're going to be supported. But companies like Zoom that have a bigger market cap than IBM, you know, you just have to look at the two companies side by side and look at the diverse nature of IBM. And I don't think IBM's being destructed or destroyed. I just think that Zoom is incredibly overvalued based on the traditional PE multiple. And remember, your growth has to, you know, justify or be supported by your PE. They have to be equal or close to being equal to support it. And I just don't see Zoom, you know, growing at the rate that their PE, you know, supports.
So where do you see the value? Like where did you rotate like since March and then a little bit more recently? Like I'm guessing,
Yeah, I
taking
invested.
eventually some trimming some tech positions and reallocating. Where do you see the value today?
Yeah, see, I was too much of a wimp, and I haven't reduced my equity exposure in technology because I don't want my clients to miss out. But I did put money into the financials and small cap value, and I was very lucky I did it then. I've rotated a little bit out of utilities, but mainly it's been I'm afraid to miss out on the growth on the technology, which is exactly why the technology is going higher.
Yeah, but it will have to correct a little bit further. It's already started correcting anyway.
Yeah.
Yeah. Yeah, that's great.
Well, thank you very much, everybody. Marty, thank
That's a great question.
Thank you, Ed.
Log it in and just bring it up here and just. Fantastic. Listen, Ed, there's questions. Hopefully you stick around to answer the questions. And Ed, hopefully you can also share how people get in touch with you.
They can get in touch with me at my website, ed@chapwoodinvestments.com is my email. And my website is chapwoodinvestments.com.